Hello, welcome in. Hey, everybody. My name is Dwayne Campbell. Welcome to my channel. So, listen, I want to be sharing something with you tonight, uh, based on something that a friend of mine asked me a question about. I've been in sales for over 20 years now, and about 12, a little over 12 years, almost 13 years, was spent in the car business. Started off in sales, became a leasing manager, internet director, finance manager, sales manager, all of that. And have a lot of knowledge about how the car business works. But a lot of my time was spent in finance. I was a finance manager. So he asked me a question uh, about buying a car, and the specific question he asked me was a little different. I'm like, okay. So I wanted to know why he was asking me that, and my suspicions were true. All right, so I'll be sharing with you tonight what I shared with him. And so here's what I shared with him. So when it comes to lending, there are three C's that we would pretty much say in auto lending. Now, this can also transfer over to mortgage lending, even some private investing, business loans, things of that nature. All right, so there were three C's basically that lenders look at. Capacity. All right. Character. And capital. Man, my writing is horrible. Okay, so capacity, what is that? That is your ability to pay back a loan. When banks look at, lenders look at your profile, what is your ability to pay back this loan? What do you make? What do you have coming in versus what do you have going out? We hear a lot in the mortgage lending, debt to income ratio, right? But it's in everything. And so they want to know, what is your capacity? Next is character, your credit. That's who you are. How have you dealt with lenders in the past? Did you pay them on time? Did you pay them back? Did you pay them late? How did you pay them? Right? And they look at your total picture. Now, if there are one-offs, anomalies, things like that, you can get an explanation letter and they'll take that into consideration. All right. And the last one is capital, right? Your on-hand cash. What do you have readily available to put down on this loan? Now, these two are more heavily weighted than these because a lot of times in lending, banks will say, okay, let's take the cash away. This person doesn't qualify. So the cash does not influence my decision. That's where you come in. That's where I would come in as a finance manager to get the bank to do what we need them to do to help the customer, right? All right, so those are the things that they look at. Now, what happens is when they look at your profile, they come up with what is called a probability of payment. What is the probability that this person is going to give us our money back? We're going to get paid back. We're lending you 30, 40, 50, 60, 70, 80, $100,000. Are we going to get our money back, right? That's what banks want to know. And even in business loans, if you have investors come in, they're going to want to know, how am I going to get my money back, right? And so that's why when you're doing that type of loan, they want a business plan with an exit strategy. You have to have your exit strategy in there because we all feel like our business is going to work, right? But that's another story. All right, so now what happens is this is how your interest rate is calculated. That's what determines your interest rate. That's also what determines your term. How long will they lend you this money? The shorter the term, the better for the banks, right? So if you don't have, let's say you have a 600 credit score, right? So if you don't have good credit and you're going for this car loan, right? The banks will say, okay, we only want to go 48 months or 54 months, or we may stretch it out to 60 months, right? So the lower your credit, the lower the probability of repayment determines your term and your interest rate. Okay, so let me give you an example. So let's say you're looking at a vehicle with a loan value, LV, loan value of $30,000. Okay, and we'll use this scenario right here. Let's say you're a 600 credit score, right? That's fair credit. Let's say the bank says, okay, for you, we're only going to loan 80% of this amount. Okay, 80% of $30,000. What's that? 24. Okay, so 24, is that right? Yeah, 6. Okay. $24,000. $24,000. That's what we'll loan you, and we feel comfortable because if something happens, we want to be able to get our money back. So what'll happen? So if the car got repossessed, they'll take it to the auction, and they'll be able to get the value of that vehicle back, with you putting miles on it, things like that. So that's how banks and lenders approach lending. They look at it in what's the likelihood of us getting our money back? What's the likelihood of you paying your payments on time and continuing to do that so we don't have those issues? All right. So now let's say the dealership says, hey man, we just got this car in. This car is great. This car is listed at $34,000. Okay. And so now you go to Mr. or Mrs. Customer and say, hey, we need $10,000 in order for us to do business. And they say, you done lost your mind. Okay, so that's where I would come in. I would go to Mr. or Mrs. Customer, and this is actually what I would say. I would say, hey, I tell you what, let me see what I can do to help. So there are 3 parts of participation in a loan. So you got the bank that's going to participate, the dealership that's going to participate, but I need you to participate as well. Okay? So this $10,000, how can you help in the participation triangle? Huh? Yeah. All right. So they'll say, hey, you know what? The best I can do, the only thing I can do is about $2,500. It's okay. Let's see what we can do. All right? Or whatever the case may be. All right? So then I will go back to the bank and I'll see if I can get them to move up in their decision, right? So that's what the finance manager does behind the scene. Okay, let's say if I got the bank to come up to 90%. Okay, 90%. So now instead of 24,000, they'll do 27 on this particular vehicle. All right, and so now then I would go to, whether it's a used car, new car, I go to the salesman and say, hey man, got this lady right here, very nice lady, family, whatever. This is where we are. They're going to help. I got the bank to help. Now I need you to help. What can we do here? They'll say, okay, you know what? I'll let it go for 32. Okay? I'm sorry. This is, I didn't plan this out. All right. So 32,000, 27,000. We're 5,000 away. They're participating 2,500. So now we're only $2,500 away from a deal. Okay? So now you go back to Mr. and Mrs. Customer and say, hey, this is what we need, blah, blah. So that's how a deal works. And that's how, you get everything worked out. Okay, so here's a question. So where the question comes in to whether the down payment goes to the salesperson. Now, when it comes to salespeople at a dealership, they get paid off of gross profit. So the gross profit right now on this deal is $2,000, right? So depending upon what type of comp plan they're on, it could be 20%, 25%, even 30%. So they'll say, hey, you know what? I've been working with this person for over 2 months. I can't only make $600 on this deal, right? I need to make $1,000. And so that's where you say, hey, I'm only going to let this car go for $33,000, right? That'll give me $900, blah, 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 blah. That's where people think that the down payment could go to the salesperson. It doesn't go to the salesperson, but it can affect how much money they make if they've, worked with you a long while, or if they just want to, do whatever, right? Now, for me, that was not the way I did business. I did business more on a volume basis, so I tried to help as many people as I can. Of course, you got to make a living, obviously. And I made a great living at it. But I helped a lot of people versus trying to get everything off one deal. All right. So let's kind of do a review. I want to try to keep this down to 8 minutes, but so many things are coming to me while I'm up here. So the 3 C's of lending, whether it's mortgage, auto, whatever the case may be, that affects your interest rate and it affects your term, right? And that is how the loan is structured based off the probability of you being able to repay the loan back, right? So the banks want to make sure that they are not harmed in the deal if it goes south, all right? And so now when we look at I know you probably can't read this right now, but now when you look at what the loan to value of a vehicle is, the amount of money that lenders, now I'm going to tell you the story real quick. I just thought about it. So now there was a scenario I had once. I had a family, they had 2 kids, they had one on the way. They had perfect credit. I think they were like an 850. 840, 850, so it's been 12 years ago. But here's what happened. Yeah, I kind of participated in that 08 thing. So, but no, it was real. It wasn't just because you could fog a mirror, you could buy a car. No, this is real. So here's what happened. They had a Lexus vehicle. I can't remember what kind it was actually, but there was a problem with the engine. They needed a new engine and a transmission, something like that. But they were going to have to come up with around $12,000 or $14,000 to fix the vehicle. They had a lot of miles on it. And of course, I said to them, guys, you don't want to do that. I told them to go pick out something they love, not like, because you're going to own it for the next 7 years. You're not going to be able to trade it. And they went out and picked the one with the DVD and all the stuff for the kids and everything that they wanted in it. Okay, here's what I was able to do for them. They didn't want to come up with a lot of money because they had a child on the way, right? I think the wife was going out on maternity leave and stuff like that. So here's what I was able to do. I was able to negotiate with the banks, and I got that's a percentage sign. I got 170% of the value. It was a brand new vehicle, of that vehicle financed. Yeah, I was able to talk the bank into doing that. Why? Because they had excellent credit, right? Their character was good. Never missed a payment in their life. Paid everybody back. They had capital. Not a lot. They didn't want to put out a lot. And capacity. They had good incomes. Both had good jobs. Been on the job for a while. So we were able to get them out of a bad situation into a great situation, into a vehicle that they needed for their children, right? And it worked out great. And I can't even remember how much money they put down. It wasn't much. It was like $2,000 or $3,000 or something like that, which, rarely even covered the taxes. But they didn't have to put a lot of money down to get out of that situation. So they, were able to trade out of that truck that had that engine failure in it. All right. So now there's a lot more that I can say about that, but I'm done. You can shoot me your questions in the comments. But before we go, hit that subscribe button. Send me a comment, like, share. And I want a lot of people to be blessed by this. All right. Take care. I'm your boy, Coach DC. Take care. Bye now.